Everybody wants to be a millionaire, but almost nobody wants to do the one thing that actually works. Get the damn first $100,000 saved. It's the hardest, the slowest, and the most miserable part of getting rich, and that's exactly why it's the most important. Ladies and gentlemen, if I could tattoo one financial idea on the forehead of every young person in the world, it would be this: get your first $100,000. Not from your parents, not from luck, not from some lunatic crypto scheme, but from your own discipline, your own saving, your own grinding. People laugh when I say this. They think $100,000 isn't much today. Well, that just shows how little they understand compounding, which is the closest thing to magic you'll ever see. Once you get that first $100,000, the money starts helping you. Your investments wake up in the morning and go to work. Your capital becomes an employee that never sleeps, never complains, and doesn't ask for vacation. But before that first $100K, you're pushing a boulder uphill with your bare hands. It's agony. Everyone gets discouraged, most quit. But the ones who don't quit, those stubborn, disciplined misfits, they end up with $1 million and wonder why everyone else didn't do the obvious thing. Let me tell you something important. The path to $1M is not linear, it's exponential. The early years feel useless. The later years feel unbelievable. At first, you save a little, then a little more. Then suddenly, profit from your past savings starts showing up. And one day, you wake up and the money is compounding faster than you can earn it at your job. Most people never experience that moment. Not because they're stupid, but because they quit before the system has a chance to work. So if you want your million and you want it the reliable way, the way that has worked for hundreds of years, then do what works. Save aggressively, live below your means, avoid stupidity, buy wonderful businesses or low-cost index funds, and never interrupt compounding unnecessarily. The world is full of geniuses who never built wealth, but it's never full of patient, disciplined people who didn't. People vastly underestimate how much of wealth building is really about temperament. They think the game is about brilliance, forecasts, exotic investments, or being some spreadsheet-wielding wizard with perfect market timing. But the truth is brutally simple. The first stretch of accumulating money reveals exactly who you are. When I say the first $100,000 is a test of character rather than intelligence, I'm not trying to sound clever. I'm stating a plain, unglamorous fact. Nearly anyone with a functioning brain can understand that saving and compounding work. The math isn't the hard part. The hard part is resisting every social impulse that pushes you away from delayed gratification. The hard part is enduring the boredom of consistency. The hard part is living in a world where everyone is screaming at you to spend, upgrade, show off, indulge, and mimic the lifestyles of people who are often drowning financially behind closed doors. Getting the first 100,000 is like dragging a heavy weight uphill with nobody applauding. It's slow, dull, and thankless. It forces you to confront your own impulses, your own excuses, and your own capacity for self-delusion. A person who builds that initial capital learns far more about themselves than about finance. They learn how tempting it is to inflate their lifestyle the moment they get a raise. They learn how cleverly businesses manipulate desires and how subtly peer influence pushes people toward unnecessary consumption. They learn the emotional discomfort of saying no to things that are socially rewarded but financially destructive. You don't become wealthy because you found the perfect stock. You become wealthy because you trained the ability to stay rational while everyone else is acting on impulse. That is character, not intelligence. You see, character is the ability to behave properly when the world gives you every excuse not to, and the early years of wealth building are nothing but excuses. Your friends will spend recklessly and look successful. Advertisers will whisper endlessly that you deserve more luxury. Temptation will arrive disguised as opportunity. If you can resist all that long enough to stack your first major chunk of capital, you've passed a far more important test than any academic exam. You've proven you can trust yourself with money. After all, money amplifies behavior. If your habits are sloppy when you have nothing, they become disastrous when you have a lot. Conversely, if you build discipline early, money becomes a tool instead of a trap. Another part of the character test is learning to tolerate slow progress without losing enthusiasm. Most people quit simply because the rewards are not immediate. The first $1,000 feels small, the first 10,000 feels slow, and the first 50,000 feels like watching molasses climb a wall. But what you don't see is the quiet compounding that is building under the surface. When you're going from nothing to something, the numbers are too small to impress you, but they are shaping your financial destiny nonetheless. It's psychological warfare against your impatience. And impatience is where most people fail. The world has convinced everyone that productivity must be loud and rapid, but wealth building, especially at the beginning, is quiet and painfully gradual. That patience sustained over years is pure character. You can't fake it. You can't shortcut it. You either endure the stretch where nothing seems to be happening, or you don't. And those who endure tend to win a lifetime of advantages later because they built the one habit almost nobody else has: the ability to keep going long after the novelty has worn off. The first 100,000 also forces you to recognize the power of small, repeated decisions. There is no dramatic moment that builds your base capital. It's built in grocery store aisles, in housing choices, in what car you drive, in how you handle every raise, bonus, and unexpected windfall. It's built in understanding the difference between needs and ego-satisfying wants. Intelligence helps you choose a decent investment. Character ensures you actually save enough to invest in the first place. Intelligence helps you understand compounding. Character helps you let compounding run uninterrupted. Intelligence helps you identify opportunities. Character ensures you don't sabotage yourself with foolish behavior. That's why this stage is the great filter. Many smart people never pass it. They think they're too clever to follow boring financial discipline. They gamble, speculate, or chase shiny distractions, believing their intellect will save them from their own impulsivity. It won't. Wealth rewards steady character far more than sharp intellect. And nowhere is that more visible than in the battle for the first 100,000. Once you finally have that capital working for you, the psychology shifts. You start to see returns that weren't earned with your sweat. You realize that money, once accumulated, behaves differently from money being accumulated. It starts to help you. It contributes alongside you. But to reach that point, you had to demonstrate the kind of durability and restraint most people never muster. And that's why I say the first big chunk of wealth is mostly character development disguised as finance. But let's move to the second point, which is equally simple and equally misunderstood. Compounding doesn't work until you stop touching the money. People treat compounding like it's some friendly little miracle that will deliver riches no matter how they behave. They think as long as they own an index fund or a few shares of a great business, the magic will take care of itself. But compounding is a demanding partner. It does not tolerate interference. It does not reward tinkering, panic, greed, or the endless urge to look clever by trading. It only pays out to those who give it uninterrupted time. And this is where most people fail spectacularly. They cannot keep their hands off the money. They withdraw it, borrow from it, fiddle with their portfolio, sell at the worst times, buy at the worst times, chase fads, flee volatility, and constantly reset the compounding clock back to zero. The human mind is wired for action. People feel productive when they're fiddling with something, but compounding punishes unnecessary action. The discipline required to leave your money alone is enormous, especially in a world that runs on stimulation, noise, and the illusion of control. You think you're improving your outcomes every time you intervene, but most interventions are wealth-destroying. The market will give you endless opportunities to be stupid, and the more you engage with them, the more you interrupt the one force that could have made you rich while you slept. You must understand that compounding is exponential, not linear. The big payoff comes only after long periods of apparent stagnation. If you keep interrupting the early stages when the numbers look small, you never reach the explosive later part. Pulling money out early is like uprooting a growing tree to check if the roots are healthy. You kill the only thing that could have grown into something magnificent. And people do this constantly. They sell too soon, they switch strategies, they panic during volatility, or they convince themselves that long-term investing is boring and that they're smart enough to do better with shorter-term maneuvers. This is delusion. Compounding is not compatible with restlessness. The discipline to stop touching the money requires humility. You must accept that time is a better investor than you are. You must accept that your emotions are not reliable guides. You must accept that boredom is not an emergency. You must accept that the greatest returns often come from doing nothing at all. People hate this. They want to feel important. They want to feel like their decisions are the reason they're succeeding. But compounding mainly rewards those who step aside and let mathematics do its work. And mathematics doesn't care about your feelings. It doesn't respond to enthusiasm. It doesn't speed up because you're impatient. It punishes impulsiveness without mercy. Another issue is that people underestimate how costly withdrawals are. If you pull out a little principal early to satisfy a desire or soothe an anxiety, you aren't just losing that amount, you're losing decades of potential growth on that amount. $1 withdrawn today costs you many dollars later. This idea is so simple, yet people ignore it because the future feels abstract. They trade long-term freedom for short-term comfort. They eat the seed instead of planting it. And then they wonder why compounding never seems to work for them, while it works marvelously for others who, frankly, may not be any smarter, but are far more patient. People also sabotage compounding by reacting emotionally to volatility. Markets go up and down. That is their nature. If you panic and sell when things look scary, you interrupt compounding at precisely the worst time. Volatility is not a loss. Selling during volatility is a loss. Compounding requires you to endure discomfort. There will be crashes, recessions, ugly headlines, and temporary declines that feel like disasters. But the people who let their capital ride through all of that without touching it, without panicking, without buying into hysteria, are the ones who end up with fortunes decades later. You can't participate in the long-term wealth creation of capitalism if you run away every time capitalism has a tantrum. Every time you remove your money from the compounding process, you force time to start over. And time, not skill, is the true engine of wealth. But time only works for you if you leave it uninterrupted. The discipline to ignore noise, resist temptation, and avoid tinkering is what separates the people who talk about compounding from the people who actually benefit from it. It's amazing how many people sabotage their own futures because they're unable to tolerate short-term boredom or short-term discomfort. So the principle is simple. You must save consistently to get the initial capital, and once you have it invested, you must leave it alone long enough to perform miracles. The world will constantly invite you to touch the money. It will wave consumer temptations in front of you, dangle get-rich-quick schemes, and whisper that you're missing out if you're not constantly making moves. Ignore all of that. The real missing out happens when you repeatedly interrupt the one process that could have quietly made you wealthy without requiring brilliance, luck, or extraordinary effort. Compounding is a powerful ally, but only for those with the character to let it work uninterrupted. Avoiding stupidity is one of the great secrets of success. Yet people insist on overcomplicating the matter. They chase brilliance, innovation, hidden shortcuts, and magical formulas, while ignoring the far more reliable strategy of simply eliminating the behaviors that reliably ruin lives. You don't need to be a genius to get wealthy. You need to consistently avoid the big, obvious mistakes that wipe out wealth before it has a chance to grow. Most people never do this. They think the game is won through extraordinary cleverness, when in reality it's won by refusing to do the obviously destructive things that everyone else indulges in because they feel exciting, impressive, or momentarily gratifying. The irony is that avoiding stupidity is far less glamorous than chasing brilliance, which is precisely why most people don't do it. But the world punishes glamour and rewards discipline, though it often takes decades for the scoreboard to reveal the truth. Stupidity in the financial world is not subtle. It announces itself loudly. It comes disguised as easy credit, high-interest debt, lifestyle inflation, speculative gambling, impulsive purchases, and the delusion that you're smarter than the market. The problem isn't lack of knowledge. Everyone knows debt is expensive and speculation is dangerous. The problem is lack of restraint. People fall into traps not because they're tricked, but because they're seduced. They want the nice car now, the expensive vacation now, the illusion of sophistication now. They overestimate their ability to manage temptation and underestimate how much damage one sloppy choice can create. Avoiding stupidity requires humility, a willingness to admit that you're just as vulnerable to error as everyone else, and therefore must design your life to prevent yourself from doing anything catastrophically foolish. One of the simplest ways to avoid stupidity is to never allow yourself to live on the edge. Leverage, for example, is a form of stupidity dressed up as opportunity. It tempts people with the illusion of faster progress. And of course, leverage works wonderfully right up until the moment it destroys you. The graveyards of financial history are filled with intelligent people who took on debt because they believed the future was certain. Then the future behaved like it always does unpredictably, and the leverage crushed them. Avoiding stupidity means refusing to put yourself in a position where a few bad months can ruin your entire financial life. It means embracing the unsexy wisdom of spending less than you earn, keeping your fixed costs low, and resisting the cultural pressure to treat consumer debt as normal. Nothing about this is glamorous, which is why so few people do it, but everything about it is effective. Another form of stupidity is pursuing complexity over simplicity. Complexity gives people the illusion of sophistication. They want the exotic trading strategy, the obscure financial instrument, the fancy model with 100 variables. The market feeds this hunger because complexity is easy to sell. But in the long run, complexity introduces more ways for things to go wrong, not right. The vast majority of people would be far wealthier if they simply lived below their means and invested regularly in broad, low-cost index funds. It's so simple that people can't believe it works. They feel insulted by the idea that wealth could be built through boring consistency. So they hunt for something more exciting, and excitement usually leads to stupidity. The markets reward patience, not thrills. Avoid the thrill-seeking behavior, and you've already avoided half the stupidity in the financial world. Another part of avoiding stupidity is being brutally honest about incentives your own and everyone else's. People underestimate how much foolish behavior is driven by misaligned incentives. Salespeople have incentives to sell, not to protect customers. Friends have incentives to impress, not to give sound financial advice. Social media has incentives to promote envy and impulsive consumption. Even your own brain has incentives to seek immediate pleasure, to avoid discomfort, to indulge in optimism. If you don't recognize these incentives, you will walk straight into traps that could have been avoided with a little rational thought. Successful people don't rely on willpower alone. They structure their environment to minimize stupid decisions. They automate their savings, avoid situations where temptation is high, and develop a healthy skepticism toward anything that sounds like a shortcut. So much of avoiding stupidity boils down to a refusal to abandon common sense. If something looks too good to be true, it probably is. If everyone is rushing into a hot trend, you should be suspicious. If someone guarantees high returns with low risk, you should run. If a flashy lifestyle seems to appear overnight, you should assume that debt is hiding behind it. You don't need to predict the future to avoid stupidity. You only need to recognize the timeless patterns that have ruined people for centuries. Greed, impulsiveness, envy, impatience, arrogance. These patterns don't change, so the strategies to avoid them don't change either. Now let's move to the fourth principle, which is just as important: buying things that get better while you sleep. Wealth becomes significantly easier once you stop trading hours for dollars and start owning things that grow even when you aren't sweating for them. The world does not reward you merely for effort, it rewards you for ownership. People misunderstand this truth because they are raised to equate work with income, as though the only money worth respecting is the money you grind for. But the wealthiest, most financially stable individuals in history made their fortunes not just by effort, but by owning assets that appreciated: businesses, index funds, real estate, productive enterprises that continued compounding regardless of their mood or daily schedule. Buying things that get better while you sleep is an antidote to the economic treadmill most people spend their lives on. When you rely solely on earned income, your financial progress depends on your time and your health. If either fails, your income collapses. Productive assets solve that problem. They expand your financial capacity beyond the hours of your day. They allow your money to work even when you're not. And the key word here is productive. An asset should produce something: profits, dividends, rental income, or long-term appreciation supported by fundamental value. A luxury car isn't productive, it depreciates. A closet full of gadgets isn't productive, they become obsolete. A high-end lifestyle isn't productive, it consumes. People spend fortunes on things that drain their wealth and then act confused about why they never build any. When you buy things that get better while you sleep, you align yourself with the power of compounding. A great business reinvests profits into expanding its operations, thereby increasing its future earning power. A broad market index fund captures the collective growth of thousands of companies working around the clock across the entire global economy. Real estate can produce rental income and appreciate over decades as populations grow and land becomes more valuable. These forces do not care about your schedule. They don't need your permission to keep working. They don't stop because you're tired, sick, busy, or sleeping. They compound relentlessly, and the longer you own them, the more dramatic the outcomes become. But buying productive assets requires a shift in mindset. You have to stop thinking like a consumer and start thinking like an owner. A consumer asks, "How will this make me feel right now?" An owner asks, "How will this grow over decades?" Consumers think in terms of hours and purchases. Owners think in terms of years and value. This mental shift is the dividing line between people who stay stuck in the cycle of earning and spending versus those who build lasting wealth. The hardest part is that ownership often looks boring at first. A portfolio of index funds is far less exciting than a new phone or a luxury vacation, but the former will quietly improve your life for the next 40 years, while the latter disappears almost as soon as the credit card transaction clears. Another advantage of buying things that get better while you sleep is that it protects you from the erosion of inflation. Inflation punishes savers and consumers but rewards owners. A dollar saved loses value over time, but a productive asset often increases in value because it represents participation in the growth of the economy. Productive businesses raise prices, rental properties adjust rents, and the value of scarce resources increases. Owning productive assets is how you stay ahead of inflation without needing constant financial maneuvers. The assets do the heavy lifting for you. People make the mistake of thinking they need sophisticated knowledge to buy productive assets. The truth is far simpler. You can own shares of broad market index funds with almost no effort, and these funds give you fractional ownership in thousands of companies. You can buy shares of a great business and hold them for decades. You can acquire real estate in areas with strong fundamentals. None of this is esoteric. The problem isn't lack of knowledge. The problem is lack of patience. People buy assets and then get bored or scared and sell them too soon. They forget that the real magic of productive assets happens over long time horizons. The early years feel slow because compounding is still gathering momentum, but after enough time, the returns accelerate. The problem is that most people interrupt the process before it gets interesting. Buying things that get better while you sleep is also a hedge against your own limitations. No matter how talented you are, your time and energy are finite. You can only work so many hours. You can only learn so many skills. But productive assets don't share your limitations. They don't need sleep, vacations, or motivation. They are engines of wealth that run independently of your daily effort. This is not just about financial growth, it's about freedom. When your wealth grows without requiring constant labor, you buy back your time. You give yourself options, you create a margin of safety in your life. That margin is one of the greatest luxuries a person can ever achieve. All of this is rooted in a simple idea: wealth is what remains after you stop working. If your income stops and so does your financial progress, you are not wealthy, you are dependent. But if your assets continue growing even when you're inactive, then you have tapped into the real engine of financial independence. That is the essence of buying things that get better while you sleep. It's not about being clever, it's about being rational. It's about recognizing that the world is full of businesses, technologies, and enterprises that grow over time, and that you have the privilege of owning small slices of these engines of progress simply by investing consistently. The sooner you adopt this mindset and the longer you hold to it, the more astonishing the results become. Avoid stupidity relentlessly and buy things that get better while you sleep. Combine these two principles with patience and discipline, and you'll find that wealth accumulation is far more certain, far less stressful, and far more durable than people imagine. The path is not glamorous, but it is reliable, and reliability is what builds fortunes that last. Patience is the one virtue people admire in theory and abandon in practice. Everyone claims to understand the power of long-term thinking, yet almost no one behaves as though time is their greatest financial ally. The modern world is built to erode patience. Every app, every advertisement, every cultural message is designed to accelerate desire and shrink time horizons. People want immediate rewards, immediate results, immediate validation. They treat delay as an insult. And because of this mindset, they sabotage the one force that could have made them wealthy without requiring brilliance, connections, or extraordinary talent. Time will do what you cannot, but only if you let it. The trouble is that the early stages of compounding feel like nothing is happening. You put money away month after month, and the numbers grow at a pace that feels more like erosion than acceleration. The human mind is wired to see straight lines, not exponential curves. When people don't see rapid progress, they assume the strategy isn't working. They start looking for shortcuts, clever tactics, or supposedly more exciting investments that promise faster results. They abandon the slow, steady path that actually works, and then wonder a decade later why they are still financially fragile. Time is a multiplier, but it's brutally slow at the beginning. That's the price of admission. You have to get through the long, dull, quiet years when the compounding engine is still warming up. And this is where character appears again. Most people don't quit because the system fails. They quit because the system requires more patience than they possess. They underestimate how many small, unglamorous decisions are needed to give compounding enough runway to reveal its power. Patience, in this sense, is not passive. It is active discipline. It's deciding that you don't need to be entertained by your own investments. It's deciding that you don't need constant novelty. It's deciding that you prefer being rich later over looking rich now. Another reason time works so effectively is that the world itself grows. Human productivity increases, businesses innovate, populations expand, and technologies advance. When you invest in productive assets, you are not merely relying on arithmetic, you are harnessing the cumulative progress of civilization. You are essentially betting that human beings will keep getting better at producing value over the next several decades. That's a pretty reliable bet. The problem isn't that the world fails to grow. The problem is that people don't stick around long enough to benefit from the growth. They hop in and out of investments like nervous squirrels, never giving compounding the time it needs to express itself. Time rewards those who participate consistently and punishes those who behave erratically. Patience also works because most people are profoundly impatient. In markets, your temperament is competing with the temperament of millions of others. When volatility shows up, most people react emotionally, they sell too quickly, or they buy too late, or they chase whatever is trending. If you are simply willing to be more patient than the average participant, you gain a structural advantage. You're not fighting for scraps. You're capitalizing on the predictable impatience of the crowd. Markets are designed to transfer wealth from the impulsive to the patient. This process has been repeating for centuries, and it will repeat for centuries more because human nature doesn't change. Time also minimizes the role of luck. In the short run, luck dominates. A few weeks or months can be distorted by random events, headlines, panic, euphoria, or temporary mispricing. But over long horizons, fundamentals reassert themselves, great businesses grow, broad markets trend upward, rational strategies outperform chaotic ones. When you give your investments decades, you allow mathematics and economic progress to overpower randomness. Short-term luck becomes irrelevant. Long-term discipline becomes decisive. People who rely on luck try to outsmart the market. People who rely on time let the market do most of the work for them. But patience is meaningless without stability. You cannot behave patiently if your lifestyle forces you into financial emergencies every few months. You cannot let time do its work if you're constantly withdrawing money, panicking during downturns, or scrambling to fix self-created crises. Patience requires a margin of safety. It requires avoiding debt, living below your means, and building emergency buffers. The irony is that the people who most need long-term investing are the same people who undermine it by refusing to structure their lives around stability. You can't be patient if you're financially fragile, and you can't let time work for you if you're constantly sabotaging your own timeline. Now consider what happens when time finally does its job. After years of steady contributions and unwavering patience, something strange and magical begins to occur. Your investments start growing faster than your contributions. The compounding becomes noticeable, first mildly surprising, then astonishing. You begin to see numbers that would have seemed absurd to your younger self. This is when people finally understand, viscerally rather than intellectually, why time is the ultimate ally. But by this point, most people have already quit. They gave up during the quiet years. They became restless. They chased distractions. They derailed themselves before compounding truly woke up. You must be willing to endure the invisible years if you want to enjoy the extraordinary ones. This brings us to the next principle. Your financial freedom arrives gradually, then suddenly. People imagine wealth as a linear progression, incremental, predictable, steady. But real wealth behaves more like an avalanche. It starts with tiny snowflakes accumulating quietly on a mountainside. For a long time, nothing appears to change. Then one day, the structure tips, and everything accelerates at once. This is how compounding works. It feels like nothing is happening for years. Then it feels like everything is happening at once. The problem is that people judge the process too early. They expect visible progress when the system is still in the foundational phase. They forget that the bulk of the exponential payoff comes near the end of the journey, not the beginning. The last few years of compounding can often produce more wealth than all the previous decades combined. But most people never reach that point because they don't believe in the process strongly enough to endure the early monotony. They want excitement, proof, validation, and dramatic change. Compounding offers none of that until the very end. The system rewards those who behave with long-term rationality even when the short-term appearances are unimpressive. Consider how a retirement account grows. The difference between 10 years and 20 years is noticeable but modest. The difference between 20 years and 30 years is more dramatic. But the difference between 30 years and 40 years is staggering. That final decade often delivers more growth than all the previous decades combined. That's the suddenly part. But if you don't survive the first 3 decades without blowing up your financial life, the final decade never arrives. People misunderstand wealth accumulation because they think their financial lives will improve in a smooth, predictable fashion. In reality, the breakthroughs come in leaps. You may spend years feeling like you're making slow, frustrating progress. Then one day, a combination of investment returns, accumulated habits, and improved decision-making converge, and everything accelerates. This is why quitting early is so foolish. You might be walking away 5 minutes before the miracle. If you've laid the groundwork properly, consistent saving, rational investing, avoiding stupidity, and letting time work, your wealth will eventually gain momentum that seems disproportionate to your effort. Another reason financial success arrives suddenly is that your own behavior improves gradually until it becomes dramatically effective. You learn from your mistakes, you stop chasing trends, you become immune to panic, you stop caring about what your neighbors are buying, you learn to say no, you learn to delay gratification, you learn to automate good behavior. None of these improvements feel revolutionary at first. They feel like small, almost trivial adjustments. But over time, these habits accumulate. You become more stable, more rational, more consistent, and then one day, your financial life reflects the cumulative effect of all these small improvements. It looks like a sudden breakthrough, but it was built brick by brick through years of evolving behavior. The sudden arrival of wealth is also tied to the fact that the world rewards ownership disproportionately as time goes on. When you own productive assets, you participate in the growth of the larger economy. As businesses expand, innovate, and become more efficient, the value of your ownership rises. If you remain invested long enough, you inevitably experience the long-term upward trend of human progress. But people ruin this by constantly interrupting their ownership. They jump out when the market dips, jump back in when it rises, and treat investing like a series of emotional reactions rather than a slow accumulation of advantage. Those who remain steady, who refuse to be whipped around by noise, end up experiencing that sudden leap in wealth simply because they stayed in the game. It is also worth noting that financial freedom feels sudden because it changes your psychology. There comes a moment, if you've been patient long enough, when money stops being a source of stress and becomes a source of opportunity. You realize that your investments can cover your basic needs, then more than your needs, then far more than your needs. This transition can happen within a few short years, even if it took decades to reach the threshold. The stress drops off a cliff. The options expand rapidly. Life suddenly feels different, lighter, freer. Again, it appears sudden, but it was earned through years of disciplined choices that seemed unremarkable at the time. Financial freedom also accelerates because of momentum. Once you have a solid financial base, every good decision becomes easier. Investing becomes easier because you're no longer emotionally attached to every dollar. Resisting lifestyle inflation becomes easier because you've internalized the value of freedom. Avoiding stupidity becomes easier because you've seen the results of prudence. Staying patient becomes easier because the rewards are visible. Your behaviors reinforce each other, and the system compounds not only your money but your mindset. This feedback loop speeds everything up. That is why the final stretch often feels like leaping several steps at once. You must understand that the sudden surge is not magic. It is the delayed visibility of long compounding. It is the cumulative payoff of decades of refusing to do stupid things while consistently doing the right things. It is the financial world finally acknowledging the discipline you maintained while everyone else was distracted by shiny objects. The tragedy is that so many people abandon the process before this moment arrives. They mistake slow progress for no progress. They mistake discomfort for danger. They mistake monotony for failure. The people who succeed are the ones who remain steadfast through the long drought before the storm of abundance. When financial freedom arrives, the world might call you lucky. They might say you were in the right place at the right time, or that the market rewarded you. They might even imagine that you possess some secret insight. But the truth will be far simpler. You were patient when others were not. You allowed time to work while others kept interrupting it. You stayed calm while others panicked. You accumulated assets while others accumulated liabilities. You stayed on the path when others wandered. And because you stayed long enough, your financial freedom arrived gradually, then suddenly, exactly the way compounding has always worked for anyone stubborn enough, disciplined enough, and rational enough to trust the process longer than everyone else around them.